This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Let's go through now and look at external audit. I think there was quite a bit of focus on internal audit in your certificate level. Now we just move it on to look at it from an external perspective. Remember why we have an audit. An audit is essentially giving verification or reasonable assurance over the financial statements, because the shareholders are the principals, aren't they? The directors are the agents. They are appointed by the shareholders to run the business on behalf of the shareholders. And the shareholders need to be able to go through there, don't they, and see that the directors are running the business in an appropriate manner. Okay, so it's a process whereby the external auditors are appointed to review the company's financial statements. And then what happens is that the auditors, once they've reviewed the financial statements, will go through there and express their opinion. Okay, and we'll look more about the audit opinion a little bit later on. Okay, but in terms of what the external auditors can go through there and do, what their duties are, when we say prepare a report, that's looking at the report being, or the financial statements being, true and fair. Okay, so true, factually accurate, fairness being, if you like, free from material misstatement, and also there it wants to show a fair presentation. And to show a fair presentation, you need to have followed the appropriate accounting standards. Okay, which then should assume that then things are factual, free from bias, and reflect, the commercial substance, which is what accounting standards are based on, isn't it? Accounting standards are based upon substance, aren't they? We will see that later on. Okay, and again, we mentioned fairness, didn't we? But again, that's there, free from material misstatement. They don't go through there and look for tiny little errors. Okay, they look for large errors, and then will hopefully persuade the directors to correct those errors. And if they can't correct the errors, then they will modify their opinion. Okay, again, when you're looking there at the opinion, that opinion should hopefully go through there and give, is it what we refer to as reasonable assurance. Okay, we're not saying that they are 100% accurate, but they are free from material misstatement, and you can take reasonable assurance that they are true, fair, and should give a fair presentation. Okay, when you're going through there and preparing the audit report, the auditors are looking at the following 5 things. Compliance, if you like, with legislation. So that's going through there and essentially looking at, are they complying with the accounting standards? Are they complying with local rules and regulations in the UK? Are they complying with the Companies Act? Again, we want to consider the truth and fairness of the accounts. Are adequate records and returns maintained? Okay, so is there backup to the numbers that are being presented within the financial statements that the auditors can go through there and use to verify the amounts and come to a correct decision about the fairness of the accounts? They need to see that the numbers in the financial statements agree to the numbers that are within the invoices, within the bank statements, etc. And any other information that's presented, whether it's in, say, the director's report, the chairman's report, that is consistent with the information that you have audited. If you think about the chairman's report, the director's report, they like to focus on the positives, don't they, and emphasize how brilliant everything is. We need to check that what they say, things are brilliant and that they are doing well, and not neglecting some serious areas that could do with some explanation. Okay, if you are an auditor or have been in the past, you will know the following: the rights that you have. Okay, you have the access to the records, so you can go through there and check any bank statements, any invoices, any returns that have been filed, board meeting minutes, anything that the company has at their disposal. You can essentially go through and gain access to it. You should then, if you are unsure of something, be allowed to get information and explanation from the directors as to why they have treated that entry as such. you get the right to go to the general meeting. So once you've prepared the audit, or you've done the audit, audited the financial statements, those financial statements are authorised, and then there will be votes at the annual general meeting. You can attend that general meeting as well to hear the shareholders' thoughts. Okay, you have a right to speak at the general meeting. So if you're not happy with the accounting treatment and the directors have refused to go through there and adjust the accounts to how you think they should be, to give a fair presentation, as well as adjusting or modifying your audit opinion, you can go through there and speak at the general meeting. And likewise as well, you have rights in relation to written resolutions and the right to require the laying of the accounts, okay, i.e. That they are authorised and therefore published, okay. Again, not very exciting. In terms then, if you like, of the audit report itself, again, all I would do is I would do an internet search and look at audit report examples. I'm not going to go through here and pull together a full audit report for you. You need to do a little bit of work under your own steam. And I think there may even be some audit reports contained within the study text that you use. So let's not regurgitate stuff that's already been there. Okay. The content of the audit report, again, I think the key bits that you've got there, the 1, 3, and 6 are fairly standard. The key ones that I think that can change is the basis of the opinion. Okay, so why have you formed the opinion, and what that actual opinion is itself. Okay, because that's what the shareholders need to understand to gain reasonable assurance. Okay, the shareholders would expect to see a date and a signature. The shareholders know the responsibilities of the directors and the auditors. Okay, they know that it's part of a larger annual report. It would be addressed to them, the shareholders. The key ones there are those two. Okay, the basis of the opinion. So what work was done and how you reach the opinion, and then the actual opinion itself. Okay, i.e., is it true and fair, and give a fair presentation. Okay. So again, let's just have a look at the different types of audit opinion that you have. There are two, essentially, or two fundamental ones. You have there an unmodified audit opinion. So your opinion is that the accounts are true and fair, and that they are materially correct. Okay, if that is the case, you would give an unmodified opinion. You have no issues whatsoever. Okay, however, if there is something there that requires specific disclosure to the shareholders, then what you could go through and record is an emphasis of matter paragraph. Okay, so maybe something exists at the end of the year. It may not be resolved until after the actual financial statements have been approved. So what you can go through there is, because the event is so important, you need to draw the shareholders' attention to it. So you will put in what's referred to as an emphasis of matter paragraph. Okay, and it talks about there that at the bottom of the page. Okay, key bit is that the opinion is not qualified. So, unmodified is also referred to as unqualified. So everything is still true and fair, everything is still materially accurate, but there is just something that you need to draw the attention of the shareholders to, because that will not be resolved until a later point in time. It's essentially covering your back as an auditor, okay? So that if something bad then does happen, you can say, well, look, we forewarned you of it and you should have been expecting it, okay? Unmodified is whereby essentially there is a disagreement, okay? So an unmodified qualified opinion arises when there is either a material misstatement of insufficient appropriate audit evidence, and it is not pervasive, okay? So there's no material misstatement. So there is a material misstatement. So maybe over a particular balance, that should say or as opposed to of, or maybe there is insufficient appropriate audit evidence. Okay, so maybe a fire has destroyed all of the accounting records. Maybe there's been some form of theft of the accounting record, so to speak. Therefore, you will issue a qualified audit opinion, okay, which is not pervasive, okay. An adverse audit opinion is when the financial statements are not free from material misstatement and do not give a true and fair view, okay. So qualified is essentially over one particular balance, but an adverse opinion is whereby there is maybe several balances that are materially misstated, and therefore there is not a true and fair view, okay. The other one that you could have with your modified is that you have a disclaimer of opinion. So that's whereby you have insufficient audit evidence, and the key bit there is that that is pervasive, okay. There we go. So just to go through, finish it off, let's just have a look at a couple of examples and piece it together. So which one of the following audit opinions will the external auditors use for AB's financial statements? So it says the external auditors of AB have completed their year-end audit and disagree with the accounting treatment of a material item in the financial statements, okay. So there is a material item. We disagree with it, okay. They have concluded that the effect of the issue is material, but not pervasive, okay. So what you've got there is disagreement. So it will therefore be a modified opinion, won't it? It's one specific material item. So it's not an adverse, if you like, audit opinion, is it? It's not going to be a disclaimer of opinion because we have sufficient audit evidence. So here what you've got is it's going to be a qualified audit opinion, isn't it? Because there is a material misstatement, and also as well it is not pervasive. If it was pervasive, then we would have to do something about it and put in maybe a disclaimer of opinion, okay. So correct answer there, it is D, isn't it? Example number 2. I think it's a little bit of common sense more than anything else, but there we go. Delete as appropriate. If an external auditor does not agree with the director's accounting treatment of a material item in the accounts, the first action they should take is to something the directors to change the accounting treatments. What would you do? Force them or persuade them? Yeah, I think you would persuade them. You can't force them, okay. You can't physically go in there and say, right, you have to change this. If not, I am going to do X, Y, and Z. You can try and persuade them, okay. Explain why they should do it. Explain what is wrong, okay. How they can adjust it, what the impact would then be, and then explain, well, if we don't do this, then this is the opinion that we would have to go through and put in. Again, it is material, so we're likely to go through there and start looking at a qualified opinion, provided that it is not pervasive, okay. There we go, that's audit. There's not a huge amount of it. I think the study texts go into it in a little bit too much volume and a bit too much detail. I've just tried to cover the fundamentals, okay. If you understand the different types of audit opinion and practice them within a question, you're not going to go too far wrong.